business or investment. You can sell that asset, buy a like-kind asset, and as long as you follow the rules, you get to defer paying taxes on the profit that you made. So, what does that mean in English? You have a rental house. You've been renting out this house the last 20 years. You're sick of it, now you want to sell that house and buy a duplex. So, you give Stephanie a call, she lists the property for you. At the close of escrow, the money comes to the intermediary. You then go buy that duplex, and then we send the money to the escrow on that side, and the property closes. So in the eyes of the IRS, you sold a piece of investment real estate, and you bought a piece of investment real estate. And because you never touched the money, never saw the money, because it was with the intermediary, you get to defer paying capital gain taxes, state taxes, depreciation, recapture taxes, all the taxes that you would have paid had you not done the exchange. You get to defer that into the next property. Now, important word in there: defer, not eliminate. Okay. So if I sell my house to buy a duplex, sell my duplex to buy a fourplex. Now I'm old and tired and sick of real estate. I just say, the heck with it, I'm selling that fourplex. I'm going to pay taxes from the house, the duplex, and the fourplex. You are just deferring the taxes. You are not eliminating the taxes. So sometimes I'll have a client say, well, if I do an exchange, can I just sell this property a year from now and at the same price and not pay taxes? No, you'll still have to pay taxes from the first property. Now, one thing to remember though is sometimes people ask me at this point, well, eventually I'm going to pay the taxes. So why bother doing an exchange if eventually I'm going to pay the taxes anyway? And there are two reasons you always want to do a 1031 exchange. The first reason is, would you prefer to pay your taxes today or tomorrow?
Tomorrow.
Good answer. All right. The way I look at it is this: if I sell something and I made $100,000 of profit, and I have to pay $30,000 in taxes, I only have $70,000 to reinvest. But because I can do the exchange, I can reinvest the entire $100,000, and that $30,000 that I'm not giving the government, I get to put that towards a bigger property or less of a loan, or essentially allows me to build my real estate empire faster. The real reason people do an exchange is because most of us will never have to pay taxes. Because what happens to all of us eventually? You die. And when you die, you win. Because when you die, your heirs get, be honest, your heirs win. Because when you die, your heirs get what's called a stepped-up tax basis. And I'm sure most of you have an idea what that means, but I'll make sure we're on the same page here. If I buy something for $100,000, and today it's worth $500,000, and I sell it, I have a $400,000 $400,000 gain to pay taxes on. But the day I die, whoever inherits the property, their basis on the property is the value of the property the day I die. If your kids are like mine, the day after my funeral, they're selling all my real estate. So when they sell it for $500,000, how much capital gain do they have? Zero. It was worth $500 when I die. That becomes their basis on the property. They sell it for $500. Zero capital gain. All the capital gain, all the depreciation recapture that I would have paid taxes had I sold it before I died, it's all wiped out to them. So that's the real reason that most people do an exchange, is that you hold the property your entire life, so you never have to pay the taxes. All right, now there's a term I use in the beginning that's very confusing to a lot of people, and that term is like kind. And as a matter of fact, if you ever talk to your accountant or your attorney about 1031 exchanges, they don't call them 1031 exchanges. They call them like kind exchanges. And by the way, is there an accountant or attorney in the room?
Well,
okay, good. Very happy to hear that. But they call them like kind exchanges because that's actually what the tax code calls them as well. But it's really easy to think of what is like kind when it comes to real estate. All real estate is like kind with all other real estate. You can sell a house and buy an apartment building, a shopping center, a farm, a bare piece of land, a rental condo. Any kind of real estate can be exchanged for any other kind of real estate anywhere in America. You can sell in California, buy in Florida, buy in Hawaii. We've done exchanges to Guam and the U.S. Virgin Islands. Okay, so it can be anywhere in America, and it can be any kind of real estate. What most people don't realize is that 1031 is not just about real estate. I got a phone call in February from a woman who said, hey, I have a business doing helicopter tours. My helicopter is getting old. I want to do a 1031 exchange on my helicopter. So, any idea what is like kind with a helicopter?
Airplane?
Actually, an airplane is. But in this case, she bought another helicopter. Sold a helicopter, buy a helicopter. She couldn't sell a helicopter to buy a house. That's not like kind. I've done exchanges for people who've sold farm equipment, for people who've sold collector cars. I did a $10 million Ferrari once. We did a Picasso, not painting, a Picasso sculpture once that we did a 1031 exchange on. But that's what like kind of refers to. A sculpture for a sculpture. A classic car for a classic car. You know, farm equipment for farm equipment. As far as we're concerned today, real estate for real estate. So that is what you need to worry about when you're talking about doing an exchange. As long as it's business or investment real estate, it can be exchanged for any other kind of business or investment real estate. Now, I did say though it has to be business or investment real estate. So what kind of real estate is not business or investment?
Personal real estate.
Your primary residence, where you live. Your primary residence has a completely different tax rule. When you sell your primary residence, you have an automatic exemption. By the way, for those of you who haven't sold your house in many years, the law many years ago used to be called a 1034 exchange. That as long as I kept buying a more expensive house, I don't have to pay taxes. That was done away with in 1997. Went the wrong way there, guy.
Should be going down.
It's going down?
Yeah, they
Okay.
want a little cooler.
Oh, there we go. Good.
Okay. I don't want to disturb you.
No, I appreciate it. That's fine. We're just curious to see how you're going to do it with your glasses. You did a great job.
Oh, yeah.
Um,
I didn't get it to move quite yet.
Okay. Now, when you sell your primary
Okay, great.
residence, you get an automatic exemption. Whether what you do with the money makes no difference. So, if you're single and you sell your primary residence, as long as you've lived in the house at least 2 years, you get to keep the first $250,000 of profit tax free. If you're married, the wife gets to keep $500,000 of profit tax free. And if your gain is more than that, then you pay taxes on the amount above that. Okay, so that is the thing to remember about your primary residence. What you do with the money now doesn't really matter. All that matters is, as long as your gain is below that 250 or 500 threshold, then you get to keep all of it. If it's more, then you pay taxes. You have a question? You're gonna...
Yeah, so what if, and I don't know if maybe you want to say this to the end or not, so what if you have an investment property in another state and you've had it for 10 years and you're looking to get rid of it, well, not get rid of it, but exchange it for California.
Right.
In the next, I don't know, 1 to 3 years, let's say. And, but it's a bit underwater. But the property that you would be purchasing, obviously, would be more.
Mm-hmm.
And you're looking to live in the property that you're purchasing in X years, let's say, retirement, whatever that is.
I'll tell you what, actually, I know where you're heading with that. I'm going to be going, I think I'm going to be answering most of that question a little bit later.
Okay.
And if I don't ask that at the end, I'll make sure I cover it. Because there are definitely some issues with regard to moving into a property that was a rental, because the Congress changed the law on that a couple of years ago. So we definitely want to talk about that. But let me move back to that in a little bit. All right, primary residence is not exchangeable. Now, it is possible for your property to be both a primary residence and an investment at the same time.
Oh.
For, let's say you have a duplex, live in one side, rent out the other. Let's say that you have a property that you have a little cottage or whatever in the back that you're renting out. Maybe you have a home office. A lot of realtors have a home office. Does any realtor back there have a home office? None of them that you're admitting? Oh, you do?
Yes,
What,
I do.
Stephanie, what percentage of your house is a home office?
So it's a 3-bedroom. I have one office.
You okay? Well,
Yes.
But on your tax return, what percentage of your house are you showing as a home office?
So my CPA, she explained to me that there is 2 ways to calculate it. It's like the square footage of the house or the living space.
Right.
So and you have to remove the hallway or something like that. So.
The key is there's a percentage, right?
Yes,
So
yes.
15, 20%, whatever that percentage is, the key is if it is 15% that she's showing on her tax return as being her home office, then 15% of her sales price of her house, she can do a 1031 exchange with, because that qualifies as business or investment real estate. So if you have a house that's dual use, when I speak at Caldwell Banker offices out in the Central Valley, it's not uncommon for me to talk to people who are farmers, who have a property that they farm as well as live in. Part of the property is business, part of the property is their residence. Now, Around here though, especially if you've owned your house more than 10, 15, 20 years, it's not uncommon for your gain on your property to be well above that $250,000, $500,000 threshold. You bought the house 15, 20 years ago for $400,000, now it's worth $1.5 million. Does anybody sound familiar to a few people? Mm-hmm. Your gain is way above that $500,000, and you're thinking now to yourself, hell, I'm not selling. I have $1 million gain in this property, and if I sell it, I'm going to have to pay taxes on hundreds of thousands of dollars. I don't want to write a check to the government that big, so I don't want to sell it. I don't rent it out. I don't rent out any portion of it. I don't have a home office. I'm stuck. No, you're not. Here's a suggestion for you. Move out. Turn the property into a rental. Now, after you've been renting the property for 2 years, would you call that investment real estate?
Yeah.
Yes. Would you still call it a primary residence?
No.
Yes.
I forgot.
It still is, because the law to call it a primary residence says you have to have lived in the property for 2 years during the last 5. So the day you sell the property, you look back at the last 5 calendar years. Have you lived in the property at least 2 of those years? If the answer is yes, then it still qualifies as a primary residence. And here's the beauty of it. The IRS lets you take advantage of both tax rules at the same time. So you sell the property for $1.5 million after renting it for a couple of years. Now when you sell it, you get to keep the $500,000 as exemption, assuming you're married, or $250,000 if you're single, and you could do an exchange on the rest. So you sell it for the $1.5 million, you put $500,000 in the pocket, do a 1031 exchange on the remaining $1 million. Now mind you, you do need to buy other investment real estate. You're not buying another primary residence. But if you have another place to go live, move in with your kids. I'm sure they'd love it. And if you have a property that you know, another place to go with your other property, that is a solution for you if your gain is well above that $250,000, $500,000, and you feel that you're kind of stuck where you are. Okay. Any questions about that though?
How long you have to rent the house?
How long do you have to rent the house for? That's a great question. Well, let's start with it. What's the most you could rent it for and still make that work?
4 years.
3 years.
3 years.
3 years, because it has to be 2 out of the last 5 years. So it has to be less than 3 years from the time you move out to the time you sell it. So 3 years is the most. Now, what's the least amount? And the answer is we don't know. The tax code doesn't say it. What the IRS has done is when they came out with how to do this, they used an example of 2 years. And usually when they come out with these examples, most accountants say, then we know that's good. So if we know 2 years is good. Is a year and 11 months good? Probably. How about a year and 8 months? Yeah, probably. How about 2 weeks? No. And so, you know, how long is something for you to discuss with your tax person? Most accountants would say 1 to 2 years. Some say, you know, over 2 or 3 tax returns. So, yeah, I would say 1 to 2 years, but definitely discuss that with your tax person.
So what if you have a duplex,
Mm-hmm.
you sell it,
Right.
you do a 1031 exchange, you buy another house.
Right.
In that house, you let your son move in,
Mm.
okay, and then how long, and you gift all the property to him
Mm.
as time goes by. What happens when he goes to sell?
He's going to get screwed. Excuse the expression. Because there's a problem with this, and this is a very important thing, because that's what a lot of people do, is that gifting real estate to your children is a very bad idea. Because when you're gifting them the property, whether it's all at once or little by little, the $14,000 per year that you're allowed to do it, you're gifting them your tax basis on the property. And so what that means is, when he sells that property, he's going to pay all the capital gains that you would have paid, even if you died afterwards. So you give him the property, 2 weeks later you get hit by a bus, and when he sells it, he's going to pay all the taxes that you would have paid because you gave it to him. If he had inherited the property, he would have gotten that stepped up tax basis. But by the fact that you gifted to him, you give him a big tax liability. So one of the things that makes the tax code in the United States very different from tax codes around the world is that in the United States it's much better to inherit property than it is to have it gifted for you. In most of the rest of the world, that's what you do, is you add your children to title, you gift them real estate before you pass away, but not the way the tax code is written here. It's usually not a very good idea.
Well, if your estate is more than $10 million.
That's another story. If your estate's more than $10 million, have a good estate attorney, and you know, and there may be some gifting issues that make it worthwhile.
So if when you die, do they still have to pay the taxes when they inherit?
there may be an estate tax due. There may be an estate tax due, but whatever actually goes to the children, whatever goes to the heirs, I should say, not just children, whatever goes to the heirs is still at the full stepped up tax basis. It's just that before it can go to the heirs, there might be an estate tax due if the estate is worth more than $11 million, assuming for a married couple. Now,
Even if it's in a trust?
even if it's in a trust, yeah. Now, the main advantage of having a trust, I know we're getting a little bit away from 1031, the main advantage of a trust is how quickly it goes to the heirs, as opposed to having to go through probate course. So, but whether you die intestate with a will or with a trust, either way you get to stay at still the same stepped up basis. But the difference is when you actually get it, because if it has to go through probate, it might be 2 years before it goes to the heirs. By that point, the property may have gone up in value, which is going to give you a tax liability. So that's why there's the advantage of having the trust.
Excuse me,
Yes.
just one more on top of that.
Yeah.
Don't they still get that $500,000 exemption when they sell the house, even if the house was gifted to them?
If they've lived there as their primary residence and shown their as their primary residence, yes, that's true. They will have that.
But with the living trust, isn't it the purpose of the living trust so that you don't have to, you can kind of, well, I don't know about in California, kind of avoid, the heirs can avoid the probate?
It avoids probate, yes. It avoids probate, that's exactly it. That's the beauty of the trust. It avoids the probate, so it goes directly to the heirs, as opposed to having to go through probate. So that's why it's much faster of a transfer from the person who died to the heirs. Whereas if you don't have a trust, it has to go through probate. Exactly. So that's the advantage. It does not avoid any estate tax, though. You have the same estate tax issues whether you have a trust or not. But you have the same probate.
Yeah, okay.
All right. Anyway, so again, this just gives you an idea of what you can do if you have a primary residence, if your gain is substantially more than the exemption. Now, how about a second home? How about a little house that you like to go to on weekends? Is a second home considered to be an investment real estate? The answer is no.
Oh, really?
If it's a property that's strictly for your personal use, it's not investment real estate. Now, let's say it's not here. Let's say it's in Hawaii. And you go there for 2 weeks per year, and when you're not there, what do you do with it? Rent it out. Now it's called a vacation rental. That does qualify. So vacation rentals do qualify, but one that's for your own personal use does not. Now, not many of us have second homes, but frequently we will have a property that we're letting our son live in. Are now we charging our son rent? No. That's a problem. Because if you're letting a family member live in a property for little or no rent, the IRS says that's not an investment. It's not even a primary residence. It's basically a property not held for investment. It's a property held for the benefit of the family, and therefore is not considered to be an investment. So if you do have a property that you're letting a family member live in, you need to be charging them market rent on that property for the IRS to truly to agree with you that it is an investment and qualifies to do an exchange. So that's one thing. If you do have a family member living in a property, at least from a tax perspective, you want to be charging them market rent on that property.
If you do vacation rental, how many weeks per year would qualify you as a rental? 1 week or?
In order for the property to be considered a vacation rental, the IRS came out with a very clean guideline. You must rent the property for a minimum of 2 weeks per year to non-family members, by the way. And your personal usage of the property cannot exceed 2 weeks per year or 10% of the days rented. So if you have a place in Hawaii that you can rent out 300 days, that you actually rent out 300 days per year, you can use it 30 days. But for most people, if it's not one that you do, it's a constant rental, you can use it up to 2 weeks per year. And if you do that for 2 full calendar years, then it is by definition to the IRS a vacation rental and does qualify for 1031. Yes.
What if it's out of the country?
And no, 1031 is only for U.S. property. 1030, when you sell and buy, what you sell and what you buy has to be within the United States. If you own property in another country, it does not qualify to do an exchange. It has to, everything we're talking about here is strictly within the United States and its territories.
Okay.
Now, there's another kind of property that a lot of people get confused about. Has anybody here ever bought a beat-up old house? You change the windows, you paint the grass, you put it back on the market. What do we call that?
A fixer-up.
A fixer-upper, a flip. Is that investment real estate?
Sort of.
No.
Uh-uh.
No. Did you do an exchange on that? Oh, good. When you buy something because you could sell it for more money, the IRS calls that a job. It's not considered to be an investment. The way I look at it is this. If you go to Safeway to buy a can of soup, is that soup an investment? No, it's inventory, right? They bought it from Campbell's and they're selling it to you at a profit. They buy a chicken, they cut the head off, they wrap it in plastic, and they sell it to you. That's a fixer-upper. They bought it, they fixed it up, and they sold it to you. That's exactly what you're doing with real estate. You're buying, you're fixing it up. You're not owning the property as an investment. As an investment means you're either running your business from it, you're getting rental income from it. In the case of bare land, that's considered an investment because it's held for appreciation purposes. But that's what investment is. If you buy it because you can sell it for more money, that's taxed as ordinary income. It is not considered to be investment, does not qualify for 1031. Similarly, if you build a spec house, you buy a beat up old property, you bulldoze it, build a spec house and sell it off, that's not an investment. That's a development. Even if you have a regular job and you do it once in your lifetime, that's not considered to be an investment. It's considered to be a development. It's considered to be purchased for the purpose of resale, and therefore does not qualify for exchanges.
What if you, once you fix it, you rent it for a couple of years?
You buy it, you put a renter in there for a couple of years, now is it investment real estate?
Yes.
Absolutely. The thing is, most people who are flipping property don't want to wait 2 years, because I know what the market is today. I'm not sure what the market's going to be like in 2 years. It might be better, it might be worse, who knows. But yes, if you put a renter in there for a couple of years, now is definitely investment real estate. But if you don't, then that's where you have a problem.
So what do you do with the gain on that selling of the fixer-upper that you gain the money? Is it income tax?
It's considered income tax, and this tax is ordinary income too, which could be as high as 40% for federal and 13% for state.
Unless you try to do another thing.
But that's not, no, he's talking about on a flip. On a flip, you can't do a 1031 exchange.
No,
but,
after 2 years.
but after you rent it, yeah. Because you're renting it, he's not renting it, he's selling it. Okay, so, but and that's a very common thing. I get that question almost daily. People who want to do an exchange on a flip. That's why I want to make sure you realize it doesn't qualify. All right. Now, the process of the 1031 is actually very simple. You're essentially selling a piece of real estate and buying another piece of real estate. It's really not much more complicated than that. You call up a wonderful agent from here. They list your property. Once you find a buyer, that's when the intermediary gets involved. We need to be involved as on the during the escrow, so that at the close of escrow, the escrow officer sends us the money. Then you go out and find a replacement property. We wire the money to the title company, and the property closes. In other words, you sold something, you bought something, we just held the money in between. So you're going through the regular sales process and the regular purchase process. The one thing to remember though is you have a very strict timeline when it comes to the exchange. You need to know what you're going to buy within 45 days. You have 180 days to close escrow, 45 days to identify what you're going to buy, 45 days to identify what you're going to buy, 180 days to close escrow. And both of those clocks start the day escrow closes.
45 plus 180?
No, good question. The 45 and the 180 are concurrent clocks, both starting at the close of escrow. So what does identify mean? Identify means you give us a piece of paper that literally says, I'm going to buy 123 Main Street. I'm going to buy 456 Saratoga Road, unit number 3. Okay? It is the exact property you're going to purchase. If you're buying it with a friend, I'm buying 1/2 of 123 Main Street. It is the exact property. Now you can identify up to 3 properties, but when midnight strikes on the 45 days, whatever you've identified, click. You are locked into. You have to buy from that list. No extensions, no exceptions, no excuses. That's why that 45-day clock is so absolutely critical. So,
Returns,
excuse me?
returns,
I'm sorry.
cancellation.
45
days, I didn't
if you don't find anything in the 45 days, you don't identify, here's your money back, pay taxes.
pay taxes.
Right. So, a lot of times people will ask me, well, I may not find anything in the 45 days. Here's my answer to that. Try. Sell the property, put it in the exchange. If at the end of the 45 days you haven't found something that you liked, you get your money back and you pay the taxes. So it doesn't hurt you to do the exchange. Our small fee to hold the money is like an insurance policy. You're basically buying yourself that extra time to do so. But if you do find something, fantastic. So it does give you that 45 days is absolutely positively critical. By the way, those are calendar days. So if your deadline falls on Sunday, that's your deadline.
But, you know, if you walk away remembering pretty much nothing about 1031, but remember one thing, remember the 45 days, because as far as the process goes, that is the one number that's going to really dictate what you're doing.
So we couldn't do this in 45 days, 180 days.
Right.
But I come back to you and say, what about doing a reverse?
Okay. Everything we're talking about tonight is called a regular 1031 exchange. You're selling, then you're buying. Even if you sold your property and we didn't find property, there's still no reverse exchange. A reverse exchange is when you buy first. A reverse exchange is a substantially more complicated process and more expensive. If we have time to talk about it afterwards, we could talk about it. I don't want to get into it today because I could spend 15 minutes just on that by itself. Everything we're talking about today is a regular 1031. You're selling, then you're buying. You could be in contract at the same time. You could be in contract to both properties at the same time, and as long as you close escrow on the one you're selling 1 second before you close escrow on the one you're buying, then you have a valid exchange. If you have to buy first, that's a reverse exchange. I'm not going to get into that today, but it is a possibility. If you want to talk more about it, we could talk more about it later, or give me a call. All right, the other part to remember in an exchange, how much do I need to reinvest? The answer is very simple, all of it. In a 1031, you are not just reinvesting your equity. You are not just reinvesting your profit. You are reinvesting everything. If I sell the property for $1 million, I need to buy at least $1 million worth of replacement property. I don't care what you buy it for. I don't care what your original down payment was. I don't care how much money you spent fixing it up. All they care about is how much you're selling the property for. So if I sell it for $1 million, I need to buy at least $1 million. Now, can you sell for $1 million but buy for $900,000? The answer is yes, you can, but you pay tax on the difference. That difference is called boot, exactly. Now, boot is what you pay tax on. If you don't mind paying a little bit of taxes, then you can go down a little bit, but if you don't want to pay taxes, you want to buy equal or greater. Yes?
So what if you sell a piece of property for $400,000, but you still had a loan balance of it of $200,000?
Right.
And that would be paid off, so you only really have $200,000
Of equity.
Yeah.
But you still need, and this is an important point, even because you sold it for $400,000, you paid off the $200,000 loan, but you still need to buy a $400,000 replacement property. So, part two of this is all of the equity, the $200,000 of cash that came from it, that has to be used as a down payment on the new property, and you have to replace the $200,000 of a loan, either with another loan, or if you want, and you have your own cash, you can use your own cash, but you do need to replace the value of the loan also. And for most people, it is by getting another loan. So
Yeah.
that's why I'm making the point. It's not just the equity; it's everything. That's why you have to replace that loan value as well.
Oh, interesting.
Yes.
Let's say in the interim, from the time you purchase the property to the time you decide to sell it and do a 1031 exchange, you have, after you purchase the property, taken cash out. That doesn't matter?
It doesn't matter at all. I had a situation like this last week, the week before last, where the person had bought the property years and years ago for like $100,000, and now they're selling it for about $1.1 million, and they owed $900,000 on the property. I mean, obviously they just use it like an ATM machine. I mean, they're just pulling money left and right out of it.
Right.
But all we cared about is at the end, they were selling it for $1.2 million. And they had to pay off their $900,000 loan, so they had to buy $1.2 million worth of replacement and use that $300,000 as equity and replace the $900,000 in loan. So it doesn't matter what you've done beforehand. It doesn't matter how much cash you pulled out, because refinancing a property is not a taxable event. That's just replacing debt with equity. All we care about is the day you sell it, what your loan amount, what your sales price. That's what has to go forward.
But the expenses of the real estate side.
Yeah, you can subtract the cost of escrow, title, the realtor fees, the cost. Yeah, there are. No, not repairs. Not repairs. Only the cost of escrow. Escrow, title, transfer tax, basically the selling cost. Which
So if you change the roof, you cannot do nothing.
you cannot deduct. Now there might be some kind of tax deduction for preparing the property for market, but that's separate from the capital gain side. So that's up to your accountant.
Did you say something about 45 days starting to close the escrow?
Yes, 45-day clock starts at the close of escrow.
I thought it starts when you sign the papers.
No, it starts at the close of escrow. So, matter of fact, that's an important thing to realize in today's market. Does anybody know what's happening with real estate today? Is real estate kind of hot or kind of cold?
Too
Hot.
hot.
It's going to go
Okay.
down.
Burning.
It's starting to slow down just a little bit in some markets, but it's still a pretty hot market. And I get this question a lot right now. I don't think we can find a property in 45 days. So here's one thing I'm seeing a lot of real estate agents do. Get longer escrows. I find a buyer for my property, but I don't want to close escrow in 10 days all cash, or even 30 days. I want a 45-day escrow. I want an option to extend my escrow by 30 days. I've seen ones where I have 45-day escrow with the option to extend 30 days. What does that do? That gives you 75 days before the 45-day clock starts. That gives you more time to find another property. So, so to the degree that you find a flexible buyer for the property, that's going to give you more time before your clock starts. So that's something to discuss with your agent as well, is to how quickly you want to close. Because I got this phone call the other day from a guy who is for sale by owner. Calls me up, says, "Hey, I got an offer on my property, all cash, closed in 10 days." I go, "That's nice. Have you already found a replacement property?" "No." "Then why do you want to close in 10 days? "Oh, I didn't think about that." That's why you hire a real estate agent, right? They tell you these things. So you went back and renegotiated, but you don't think about that, because that's the close of escrow is the important part. All right, we've gone through the exchange process. How are we doing time-wise here?
10, 15 more.
You're doing-
We have one night.
Okay. You'll get all night. The sad part is, okay, for the 40-minute mark. Okay, good. Let me talk about a couple areas where people have problems with exchanges. I'll call them the red flag areas. First red flag area: your family. The IRS hates your family. Okay, and what they've done is, back in '89 they passed a law that says essentially if you're doing an exchange where you're buying property from or selling property to family members, you're under special scrutiny. And the way they've written the rules, though, it's real clear. You cannot buy replacement property from anyone called a related party to you, like your parents, your children, your grandparents, your siblings. So anything you do with the family, call me. Let's go over the situation, because the family transactions can get kind of screwy sometimes. But here's the one here's an area where we all have an issue: vesting, title, and this is something you brought up earlier. Whoever sells has to buy. If Stephanie sells, Stephanie has to buy. She can't give the money to her son. He's a minor anyway, but if it weren't, to buy the replacement. She sells, she has to buy. Now, there's a common misconception that it has to be the exact same person on title, exact same vesting on title, and that's not correct. Because frequently, as the Wells Fargo person will attest to, they won't lend to the trust, but you own your property in the trust. So can you sell the property in your trust and buy the property in your own name? The answer is yes, because your trust is not a separate tax entity. You and your trust are the same tax entity. So selling your trust, buying in your own name, that's perfectly fine. Where we have to be careful, though, is sometimes there are entities that change. Does anybody here own real estate with somebody other than your spouse? Who do you own it with?
Niece.
A niece. So now the question is, how are you entitled to the property with your niece?
80-20.
Okay, as tenants in common, or as a partnership.
Partnership.
Okay, now if they did own an 80-20, he owns 80%, she owns 20% as tenants in common, what that means is on his tax return, he is showing that he owns 80% of the property, she is showing that she owns 20% of the property. When they sell it, each could go their own separate ways. But what happens now? Now they own the property in a partnership. Technically, he does not own real estate. What does he own? He owns a share of a partnership that owns real estate. And there are certain things that the 1031 code says you cannot exchange. You cannot exchange stocks and bonds. You cannot exchange partnership interests. And so the fact is, he cannot exchange his interest in the partnership. Now the partnership can do an exchange. Partnership sells, partnership buys. But if he and his niece want to go their own separate ways, we've got a problem. Because now we have a different tax entity moving forward in the exchange. Are there ways around this? Yes, sometimes it requires a bit of planning. The reason I want to bring this to your attention, though, is if you do own real estate with somebody other than your spouse, you own it in some kind of entity, it's better to get answers to that well before you sell the property, is if you're planning to do it, so we can get that addressed, because that can be an issue. Okay. Last thing I want to get into, exit strategies. Some of you are thinking to yourself, you know, eventually I really don't want to be managing real estate when I'm 90 years old. So what am I going to do? Well, huh?
Call me management company.
Call the management company, exactly. Got a property manager here. We'll be happy to do it for you. But if you're like my father, you know, when he retired, my father, for example, if he could manage his own properties, if he physically could go touch his real estate every single day, he didn't want it. So he just, at the end, he just sold it. But one thing he did, which I thought was pretty interesting, he didn't want to do an exchange. But what he ended up doing is doing seller financing. So when he sold the property, the person who bought it, he acted like the bank. And so he got payments every month for 20 years. And what that did is that stretched out his tax bills for 20 years. So seller financing is a great exit strategy if you're sick of real estate and you just want to sell it, but you don't want to pay all the taxes at once. So that's something to look at. Now the other thing you can look at doing is buying commercial real estate. Commercial real estate, usually less management. Frequently there are things referred to as triple net properties, where you're buying a Starbucks or a Walgreens or a McDonald's. Essentially you're buying a piece of real estate that you're leasing to a large corporation. They pay the taxes, insurance, and maintenance, which is what's called triple net, and you just get a rent check every month. So that's another possibility. There's another possibility which a lot of people do, and I think this is what you're getting back to where you were going earlier, is I own a bunch of rentals in markets that I don't really want to live in. So how about I do a 1031 exchange, all my little stuff that's out of state, and go by myself, do an exchange to a house in Hawaii. Now, after a few years of renting out the property, I sell my house in Saratoga, and I move to Hawaii. So now I'm converting my investment real estate into my primary residence. That's a perfectly legitimate thing to do after you've been renting the property for a few years. Do not ask me to define a few years, please, because that's up to your accountant.
No.
But
let
me get there. There are two ways to go here. I'm going to do both. So the first thing is, if your goal is to live that property the rest of your life, that's a fantastic idea. But the problem is, if your goal is just to live there for 2 years, to call it your primary residence, and then sell it as your primary residence, not a good idea anymore. Because Congress changed a law on that back in 2009. Now, when you move into a property that was your rental, you have to pay taxes based on the percentage of the time you rented the property before you moved in. So if you rent a property for 10 years and then move into it, live in it for 5 years, you've lived in it 1/3 of the time, you only get to keep 1/3 of the capital gain. So the idea of moving into the property, because this used to be a nice tax strategy, just move into your rental, live in it for 2 years, sell it as your primary residence, move into the next rental, live in it for 2 years. Congress basically said that's not something we're going to allow anymore. So now it's a proration. So the idea of moving into a property and living in there for many, many years, ideally the rest of your life, great tax strategy. The idea of moving into it just for a few years to establish residency and then selling it, not a good idea. So that is something that I know many people think about doing. Not always a good plan. Stephanie, I think I'm pretty much done. I don't know if you want to come up and have everybody up here for the Q&A.
Yeah.
So, so I'm sure there are a few questions both on the lending side and the title side as well. So we can get that answer. And by the way, as I'm sure Stephanie will mention, we'll all be hanging around afterwards. That if you have more questions, you're welcome to be able to answer questions. You know, we have a lot of wine to drink still as well. So as long as your drive isn't too far away, you should be fine on that side. Oh, you're heading them on the way up. That's fantastic.
I think I have, oh, it's different. Thank you.
So I have a question, Ron.
Yes.
So if I sell a piece of property, my investment property, and I bought it as a single person, so I'm the only one on title, it's investment property. So then I decide, so I have to spend, I'm gonna use the 400,000. And I'm gonna spend the 400,000 because I'm gonna buy an apartment building, but I need someone to help me because I don't have the other, it's gonna be 800,000.
Right.
So can I invite someone in to?
Okay, well first off, did you get married during that time?
No.
Okay, good. I'm very happy for you. But, okay, and I'll answer your question, then I'll come back to the spouse. Come on in, guys. Come on in. The answer is yes. You can buy what's called tenants in common. So you want to buy something for 800,000, but you can't afford it all on your own. You and I buy it together, as long as your share of it is at least the 400,000 that you sold as a percentage ownership. Then we can own the rest.
Okay.
So as tenants in common, we can own the property. Now she mentioned something earlier, which I've seen also. Let's say she sold the property to a single woman, but during the time she owned it, she got married for some reason. Now,
For
now
some reason?
because she loved her husband. But let's assume now she wants to do an exchange. Well, here's the fun thing: if she sells the property and it's her own name on title of the property when she sells, guess who has to buy the new property? Her by herself also, even if now she's married, because technically if she buys the property with her husband, she's only buying half of that property. And so even adding your spouse onto title can be a problem when it comes to doing an exchange. So
Okay.
those are a little bit there.
Yeah, but no, that's why I was asking, because I would imagine it would come up.
Very frequently, yes.
I have a question. On 1031 exchanges, I know when you're financing a property and you're doing a 1031 exchange, the lenders don't want to see subordinate financing. But on a 1031 exchange,
We don't care.
the government doesn't care.
Correct, exactly. As long as the loan is replaced with one loan, two loans, no loans, 20 loans, it doesn't matter on the exchange side. Obviously, on the lending side, there'll be more restrictions about that, exactly. But that's not a problem on our side.
So if the property in question, which is in another state, is a little underwater, let's just say 30K, right? And the property that you're purchasing is back here in California, maybe a townhouse, a condo or something, and you put, I don't know, whatever the going rate is, 10-20% down, whatever. Will they look at that and say no and won't consider it an exchange because the property is underwater?
Okay, when you say underwater, to me, the definition of underwater means you owe more on the property than it's worth.
Correct.
Okay, that's fine. If you still have a gain in the property, I mean, this is
So how are you gonna have a gain if it's underwater?
Oh, easily.
ATM machine.
You bought it for 100,000. The property value went up to 500,000. You came to this lovely lady. She got you 80% refi. You pulled $400,000 out of that property, and the property value goes down to 300,000. You owe 4. The property's worth 3. That's underwater, right?
Right.
But what's your basis on the property? 100. If you sell it for 3, you still have a $200,000 gain on the property to pay tax on. So if you pulled out money out of your investment
But
property,
what if you didn't pull out any money?
then you're probably not underwater. I'm sorry, you probably don't have a gain in the property.
Right.
If you don't have
you
a
won't
gain,
have a gain.
If you don't have a gain in the property, you don't have to worry about doing a 1031. You just take it. And one of the beautiful things about selling investment property at a loss is you get a tax deduction.
Really?
If you sell your primary residence at a loss, who cares? But if you sell investment real estate at a loss, you actually get a tax deduction for whatever that loss is.
Really?
Now, here's one thing to remember though. I have a little story for you. A few years ago, I bought a house, actually a fourplex. This is a true story, happened to me. Bought a fourplex up in Portland, Oregon, for $360,000. At the very top of the market, the very next day it crashed. I sold it last year for $320,000. Question for you: did I have to pay any taxes? I bought it for $360,000. I sold it for $320,000.
No.
The answer is I still had a gain to pay taxes on.
Why?
You know why? Because what do you do with your investment real estate every year in your tax return?
Right.
Depreciate it. And my depreciation after 8 years had gone down to $290,000. The fact that I sold it for $320,000, I still had a $30,000 gain to pay taxes on. So be very careful when you say you don't have a gain. One, maybe you did a 1031 exchange into the property so that you defer taxes. Or you've taken a lot of depreciation from the property. One thing I always recommend is if you're going to sell a piece of real estate and you really don't know what you're going to do with the money, call your accountant. Call a good realtor to give you an estimate of what you actually think the property would sell for. Take that number, go to your accountant and say, if I sell it for this much, am I going to have to pay any taxes? Because you may be surprised, between depreciation, deferred gain, etc., you might actually have a tax liability and not realize it.
So you had a house that was a second home,
Something to think about.
and then after 5 years, 10 years, you sold it.
Right,
But no, you didn't. You sold
right,
it.
right,
Now it's a basic investment.
right.
So what did they do when they go to do the 1031 exchange? during the period that you were the second home.
It doesn't matter, as long as the last use of the property when you sold it is investment real estate, the fact that you sold, the fact that it was a rental beforehand doesn't make any difference. If it was a second home beforehand, doesn't make any difference. It qualifies as investment real estate because the last use of the property was as investment real estate.
So if you have a supermarket that you own the land and the business, you sell the whole thing, can you do a 1031 exchange?
You might do two 1031 exchanges because now you can definitely do the real estate, but the question is now you're also selling the business. And the business, some parts of the business you can exchange, some parts you can't, but you can only, if you want to go buy another supermarket, you can change certain parts of the business, but most of the business itself you end up paying tax on. If you made if you're selling the business portion at a profit. The real estate you can definitely do an exchange on, but the business itself, a lot of it's going to be taxable because a lot of it is not exchangeable.
So can you turn it around by a, say, apartment building?
With a with the real estate portion of the business, yes. You still sell supermarket real estate, do an exchange for an apartment building, no problem. Okay. Any other questions? Does anybody know what title and escrow actually is?
I have a question.
Yes.
So going back to a house that's gifted to your kids,
Yes.
let's say the house was bought for $250 grand and it was gifted a few years later and now it's worth like $1 million. So you want to sell the house, what's your tax bracket on it?
Your tax. Well, first off, do you live there? Oh.
Yes, I do, sir.
Okay. And have you started? And after it was gifted to you, you shown the property on your tax return as investment real estate. I mean, as your primary residence.
Estate, yes.
And you single or married?
Getting divorced.
Uh-oh.
Are you going to sell it before or after?
I'm going to sell it after, hopefully.
Well, the main thing is this. I mean, you'd be able to sell the property as a primary residence,
Yeah.
and whether it's $250,000 or $500,000 that you would get to keep, you have a $750,000 gain in that property.
Sure.
And so, you get to keep $250,000 or $500,000, and you're going to pay tax on the rest.
So there's no way around that?
Not unless you turn it back into a rental or marry two women, then you two.
Get out of one frying pan and get in another.
I'm trying to get rid of this one.
Not the same one.
Not the same way. I was thinking, if you married two, you get 250 times 3.
I know.
No, unfortunately, you don't anymore. I thought you did, but I just found out you don't.
Then when you go live, pay $5,000.
Yeah. Actually, you know what? It's more the women who ask me to exchange it with their husbands. I tell the women, if he turns 50, you can exchange it for two 25-year-olds. All right. Does anybody else have any other questions? Stephanie, is there anything else that you wanted to? If this is your class today, is there anything else you want to talk about or you want us to bring up today?
No, I think we done a lot today. It was
It's a
fun.
great time to sell your investment property because it's peaking out. We have charts in the back that show the range of the last, 5 years of all the
The last 3 years
Last
for
3 years.
multi-units.
so the straight up appreciation and how long will the appreciation last. So it might be a good time to exchange. And I asked Ron, what are you going to buy when you sell your peaked out property here? And you might buy bigger, you might buy smaller, might buy easier.
Might be multiple.
Now some people exchange into REITs, right?
No, you cannot exchange into a REIT. A REIT is considered to be a stock. So actually, technically, a REIT is a partnership.
A
So
real estate owned
right. No, you can't do that. But what you can exchange into, there are companies who sell what are called Delaware statutory trusts.
That's the one.
That where you're buying a fractional piece of specific real estate, and so there's most people would love to own a Walmart or a Costco. I mean,
Sure.
real big, but you don't have $30 million, but you might have $3 million. And if so, you can buy 10% of it. So that you can buy percentages of specific properties called a Delaware statutory trust. There are companies who basically put a bunch of people together to buy these properties. So the
It's similar
DST
to a REIT.
it's similar to a REIT, except the difference is you're buying specific real estate as opposed to buying into an entity that buys and sells real estate that you don't have any direct ownership of the actual property.
I found people like to do that with their big money when they don't want to have to manage it.
Yes.
And
Yeah.
and it's a risk.
You're buying real estate.
Yeah.
I mean, in any real estate, whether it's commercial, residential, apartment buildings, land, it's real estate. I mean, a lot of people who bought that real estate in 2007, were very mad because they went bankrupt in 2009 or 10.
Mhm.
Well, guess what? What happened to all real estate between 2007 and 2010? It all went down. So if you bought it well, then with good long-term tenants, you might be okay. If you bought a property that didn't, it may have gone south. The key is you're buying real estate. You always need to analyze it as real estate, not like it's a stock or something like that.
So just to confirm, you can buy more than one property when you sell one. You can
Yes.
buy 2 or 3.
You can buy 2 or 3. I did. My favorite exchange was back at the bottom of the market. A woman sold her house in Palo Alto for $1.4 million. She scampers to Las Vegas, bought 18 houses.
Oh, sorry.
Ooh.
18. Now you're thinking to yourself, what the hell is she doing out there? Okay, there are two reasons she did it, and I thought these were phenomenal ideas. The first reason she did it is cash flow. Okay, her house in Palo Alto was renting for about $3,500 a month. This is 5 years ago, mind you. I know a little bit more. But then again, a 1.4 Palo Alto bulldozer. That's all you do with it. But she was renting for about $3,500. She bought those 18 houses. She now is making over $11,000 a month. So her cash flow tripled.
Okay.
Even that. But here's the best reason she did it, and I love this. She actually was a realtor. She did not have a lot of money in a 401k or anything like that. So she was using it as a retirement strategy. She goes, I'm 60 years old, I don't have a lot of money put away, but I want to keep working. So now what I'm going to do is whenever I need some money, I get to sell one house. She took that big basis of a $1.4 million big gain, split it up among 18 properties. Now when she needs some money, she sells one property. And if she needs a little more money, she sells another property. Pays a little bit of taxes every single time, as opposed to selling one big asset, paying all the taxes at once. So she actually used the 1031 as a way for a retirement strategy. I thought that was fantastic.
That is smart.
Quick question for you. So I think you mentioned something about a Delaware trust. So if you sell your property, even though it may be a little underwater, but you still said it could have a gain, and you want to buy a couple tax lien properties, let's say in San Francisco, somebody didn't pay the taxes, no, or timeshares.
No, because if you buy a timeshare, who uses it? You do. It's not an investment. And plus, you never made money on timeshare anyway. So no, you can't. The timeshare doesn't work. And unfortunately, buying houses at foreclosure, like at the courthouse steps, can't do that either. You can't buy tax liens. You have to go into contract to buy a property.
A regular property.
Regular property.
Okay.
Yeah, exactly.
Okay.
Exactly. By the way, sorry.
I was gonna have one more question.
Oh.
So I'd heard,
Okay.
just over the last, I talked to a lot of real estate agents and or even exchange persons, and they were saying that, we should think about what happens if the 1031 exchanges went away. So.
Yeah, Congress is trying to muck up the waters a little bit.
Oh, God.
Congress, you may have heard, would love to do some kind of tax reform, especially the Republicans in Congress. And this is not a partisan issue, please don't take it that way. But now that the Republicans have control of both houses, they would love to pass some kind of tax reform. And what they did last year, and actually 2013, is they came out with a kind of a laundry list of what are some of the tax things they would look at potentially eliminating in order to reduce the tax rates. I mean, they threw everything out there, charitable deductions, mortgage interest deductions are on the table, everything. One of the things that they mentioned is 1031 exchanges, because the expectation is because people do exchanges, that's money that's not going into the coffers of the government right away. I think that there's a pretty common consensus that if you don't do exchanges, what are you probably going to do with your property? Keep it and not sell it because you don't want to pay the taxes. And so we came up with a few studies that showed very clearly that if you eliminated 1031, it actually would decrease the amount of money going into the economy because it would decrease the amount of people selling their real estate in the first place. Commercial real estate, we estimate, would go down by about 40% overnight. And so, we're trying to educate people in Congress. The one thing I will say is, I think they've kind of put it on ice for now, but fully expect after the next president is elected, that there's going to be a push in Congress to come up with some kind of tax reform. And 1031 there's a chance that's going to be on the table. We're fighting it, but we will. It is possible that it will go away. It's been around. Is anybody here born before 1921? Okay. 1031's actually been around since 1921. It's been around for a long time. It was one of the first things added to the tax code after we passed income taxes in 1918. But, so it's been around for a long time. This is the biggest threat we've ever had to it. Absolutely. So it is it's something to be looking out for.
So say no.
So yeah, so on the back of my business card, there's a place on our website you can go to, basically to send a letter to your congressman. So it's literally just go there, type in your zip code, your name, and a letter gets sent to your congressman and senator saying basically 1031 is very important. Please don't let it go away. So it's on the back of my business cards if you have that. They're in the back also, but here.
Thank you.
Any other questions? Yes.
So you said that if I have a duplex and then one side of the duplex I rent it out and then the other side I live in, so could I get both, like residential and?
Yes. So whatever percentage that you show in your tax return is being rented, so let's assume there's the exact same size. 50% is rented, 50% is investment, 50% is primary residence. When you sell it, 50% of the property, you get your $250,000 or $500,000 exclusion like a primary residence, and the other 50% you do the 1031 exchange with. Yeah. So the key is going to be as what percentage you show on your tax return, either as the home office or as rented out or whatever. All right. Anything else we can answer for you guys tonight?
I just wanted to mention, those brochures that I gave you, it's very important. People forget when they're doing 1031 exchanges that they're not going to actually need to be pre-approved for a loan unless they have enough cash to do cash only. And that's very important because the lender looks at you qualifying for the property. So you do need to submit all your items, and when you're doing a 1031 exchange, it's not something that when you need financing, that you can do on your own, or that you can get a family relative to do the 1031 exchange. You really need to work with a 1031 company, a title company, a broker, an attorney, or somebody that doesn't have any interest in what you're doing in the property.
Are you licensed just for California only?
Okay. The woman who cut your hair has a license from the state of, not yours. Has a license from the state of California to cut your hair. I can hold $20 million of your money and I got nothing. I have no license whatsoever to do what I do. Our industry is extremely small. We are completely unregulated. So
you can go anywhere in the U.S.
So one, we can go anywhere in the U.S. I do exchange all over the country. But what this also means is, please only work with exchange companies who are large. This is one case where size does matter because if most of the exchange companies are backed by the title companies, we're backed by a title company. We have lots of bonding insurance, essentially making sure your money is safe. There are a lot of small companies out there who are small 1- and 2-man companies who have pretty much zero protection, guaranteeing that your money is going to be there tomorrow.
You've been around for a while.
We've been around 30 years. Our company's been around 14. If you were in the business back in 2008, 2009, there were 4 companies locally who were found having stolen clients' money. So you do want to be careful. Stay with big companies. Is the one thing I do. I always say stay with the sister companies to the title companies. They're the ones who have the security to make sure your money is safe. But I do exchange all over the country, so that's not a problem at all. Okay. By the way, on the commercial, one thing about lending on the commercial, if you do end up buying commercial real estate, which is multi-unit, more than 4 units, or any other kind of commercial, the lending requirements are very different from residential. Yeah. So whereas you may be used to buying, what the process is of buying a house or a duplex or something like that, if it's commercial, completely different process. In some ways it's easier, in some ways it's more difficult. But you definitely want to talk with a commercial lender. It's very different from what if you're thinking about buying commercial real estate.
Wells Fargo also has commercial financing, and 1 to 4 is considered residential. Anything over 4 units is considered commercial. And in those packets, I have a list of all the things needed in order to get pre-approved. And then on one side where it says 1031 exchanges, I have the verbiage because when you're purchasing a home, you need to state in the contract that it is a 1031 exchange, identify it as a 1031 exchange. So the verbiage is there that your realtor will need to put in to show it that way.
So both sides cooperate, they have to sign extra papers.
Yeah.
It's not the money from Wells Fargo, it's the money.
Yeah, I didn't get into that today, mostly because your realtors are responsible for that, but they put something in the contract just telling people that you're doing an exchange. It's just a disclosure, it's not any kind of...
They have to get the other side to agree.
Right, but the key is it's a disclosure. It's not that, because there's some extra paperwork involved, but it doesn't affect the other party. So by the way, if that means if you're buying a house and the other party is doing an exchange, it doesn't have any effect on you. Okay, it doesn't cost you anything or delay anything, it's strictly for it's just being disclosed because there's some extra paperwork for you to sign.
What is the cost for 1031?
Around $1,000. Around $1,000. Yeah. Reverse exchanges we were talking about earlier can be anywhere from $6,000 to $20,000. So that's why it's much more expensive. Regular 1031 around $1,000.
And no interest on their money in between, right?
Well, call Wells Fargo and ask them for a short-term deposit of how much interest they're giving you.
It doesn't cost that much.
No, the interest rates right now from the bank, the client gets the interest while we're holding it, but it's very, very low, unfortunately.
Yeah,